When interest rates go up, so do mortgage rates for home loans. Fed Chairman Jerome Powell addressed what he sees in the housing market.
Growth in business fixed investment appears to be slowing, and activity in the housing sector looks to be softening, in part reflecting higher mortgage rates.
Well, as we reported on Wednesday, the 30-year fixed mortgage rate surged to 6.2% this week ahead of the announcement. The rate was 5.5% just 1 week ago. So joining us to talk more about what this means for homeowners and, of course, prospective buyers out there is Tim Rood, Managing Director at SitusAMC. Tim is a housing policy advisor and expert. Tim, thanks for joining us. So we just heard Chairman Powell say that the housing market is softening. We can only think that means a good thing, right, coming up. But what changes will people start to notice about the housing market, and what are the benefits of the cool down?
Sure. What's funny is that when you listen to Chairman Powell, he was talking about like residential investment and the impact of higher interest rates on residential investment and on the housing market. His answer was a profound, I'm not sure. So I think we're all kind of navigating this together. I mean, there's no clear path. What I would say is, look, the higher interest rates, of course, is causing some downward pressure on the housing market in terms of home price appreciation. Thank goodness, right? I mean, we've been at a blistering pace. It was up 20% year over year last year. You can see that interest rates are already taking some of the air out of the balloon. You see appreciation rates now at about 15%. So again, you wanted that moderation. Not many people are forecasting any sort of a bust. This is very different than the last crisis or the last housing market, housing boom in terms of right before the great financial crisis. This looks a lot more like 1977 to 1982 when the baby boomers were coming online and starting to buy homes. And then you had Paul Volcker try to stomp down inflation back then. It's a very similar environment, higher energy prices too, except now you're dealing with the millennials. So the demand seems to be insatiable, at least for the time being. And you're going to see prices continue to moderate.
So let's talk about 2008, because I think when we're talking about adjustable rate mortgages, which a lot of people have those right now, that was partially to blame for the recession in 2008. So what does this rate hike mean for people that have those adjustable rate mortgages?
Yeah, I mean, what you saw, I think one of the problems is you have too many sellers that are locked into 30-year fixes at around 3%. I think it's somewhere around 85% of the market. So it's difficult to compel those people to actually sell. And now from an affordability standpoint, so that obviously impacts inventory. Inventory right now is still lower than it was last year. It's half of what it was in June of 2020. I mean, that's a lot to wrap your head around. I mean, it is anemic supply, but demand, while it's waning, is still really robust and outpacing supply. So you're starting to see, because the interest rates have gone up, essentially, year over year, the same house that you would have bought, or I should say the same loan amount that you would have taken out last year, this year at a 6% instead of a 3% is like 45% higher in terms of the payment. If you factor in the home price appreciation on top of that, you're like 66% higher. So, I mean, it's painful. That's why you're starting to see people look to ARMs, adjustable rate mortgages, because they can get in at a lower entry point, maybe 1% lower, which makes the house more affordable in the hopes and expectation that this will be behind us. Inflation will get tamped down, and then ultimately the Fed will be in a position to loosen rates or lower interest rates in the near future.
But of course, there's probably some danger in doing that, right? Like if things don't balance out in 3 years or 5 years, let's say, right?
Oh, no doubt. I mean, one of the interesting things, I was thinking about this morning, is that so for, 30 years ago, God help me, I'm that old, 30 years ago when I got into the industry, they actually, the rule of thumb was you shouldn't buy more than 3 times your income. So if median income was $50,000, you shouldn't buy a house more than $150,000. And that was a rule of thumb for a long time. But as interest rates have been going down steadily for 30 years, you start to see that incrementally that 3 times goes to 3.5 to 4. Well, now it's 6 times. So people are buying the median income to median household home price is now 6. So the price is 6 times higher than median income. Okay. So now if you have interest rates go up, you break that whole calculus. So now you find yourself in a position where you're having to convince yourself to buy at 6 times your median income, but the prices or the interest rates are substantially higher, which would beckon that lower multiple. So anyway, it's kind of an enigma, to say the least. But at the bottom line, if you're a young family, and right now the biggest cohort ever in terms of demographics is 28 to 34, and that's that's just obviously a group that's starting their households. And if you've been in a pandemic, and you used to say you've got a young family and you wanted to get out of an apartment 2 years ago, you're not going to be dissuaded by these higher interest rates today. You're going to fight your way into that market.
Yeah. So, Tim, really quickly here, we have about 30 seconds. Where do you expect mortgage rates to be by the end of the week?
Wow. I mean, to quote Ron Burgundy, man, that escalated quickly, right? I don't think
Crystal ball moment
expecting.
here.
Boy, I mean, by the end of the year, I mean, God, if we get past 6.5%, Katie bar the door, it's a daunting thought. It's hard to say, because if the Fed isn't making a market for mortgages, it's already been shown that there's some no bids in the market last week as interest rates went up. So, if there's a no bid in the market, for the market and mortgage-backed securities, and the Fed doesn't show up, you could go as high as 7%.
Wow. All right. Tim Rood, Managing Director at SitusAMC. Thank you for joining us today. We appreciate it.